Okay, hello everybody, back with some market information. Chicago PMI coming in at a gain from the prior month, a zero point 0.2 gain from the prior month, but decrease. We expected 0.58, 58, but we got 57.6. Now, going into the Chicago PMI, anything above 50 is going to be a positive number. So let's just take a look at this. Barometer eases to 57.4 in March. Chicago Business Barometer slips to 12-month low. Chicago Business Barometer 61.7 Q1 2018 versus 66.3 Q4. Production lowest since October 2016. The MNI Chicago Business Barometer fell 4.5 points to 57.4 in March, down from 61 in February, hitting the lowest level in exactly 1 year. So we go into the report again. It just goes into this. Let us examine here what we got going on. Firm's operation continued to expand in March, but the pace of expansion moderated for the third straight month. So that is a sign that we're not ready to keep increasing. Compared to March last year, barometer was up 0.5% on the quarter. Barometer was down on Q4 2017, but Q1's outturn was still the second best calendar quarter result since Q4 2014 and the best first quarter outturn since 2011. I don't believe it that everything's okay. I'm not buying it. I'm fucking wise. I know what's going on, guys. So, extending a trend set since the turn of the first year, firms count for the output of incoming orders fell in March. Production indicators sunk to the lowest level, while new orders decreased to a level last seen lower just over a year ago. Two winders, accounting for 2/3 of the headline barometer, have fallen 28% and 19% since their respective December's highs. Now, continue to level off. Oh, new orders. Firms level off. Unfulfilled orders also continue to level off. The order backlogs indicator slowed for the third month to 11-month low. Supplier delivery times, however, inched higher and remained long by recent standards. There were multiple reports of suppliers struggling to keep up with orders of key inputs ranging from steel to electronic components. The rate which firm added their stock levels also increased in March, just before the kickoff of the new financial year. Firms' appetite to add their workforce grew in March. The employment indicator kicked up, rising to the second highest level in the past 12 months. Special question asked firms to forecast the level of incoming orders. 50.1%. Most firms said they expected orders to grow in Q2. Only 9.4 orders thought they would reduce, with the remainder predicting orders would be more or less unchanged. The input price inflation pressures, meanwhile, refused to abate. The price paid indicator picked up in March enough to take the quarterly average up to the highest level since Q3 2011. Multiple firms reported an increase of steel, among other materials, impacting their business, while others noted persistently high prices were forcing them to find new suppliers. Chicago Business Barometer calendar quarter average had increased for the 6 straight quarters until Q1 2018, with a halt largely due to recent slowdown in the trajectory of orders and output. Troubles higher up in firms and supply chains are restraining their productive capacity, and higher prices are passed on to consumers. A more positive note, firms remain keen to expand their workforce. Well, how could you expand their workforce? We didn't even get as high as this 2011. We're going down with this barometer. This is going to we were gonna got first of all, this whole Trump thing kind of gave a boost, a needed boost to sentiment, to consumer spending, pretty much to have faith in Trump, have faith in the government. But what happened? We're starting to see a failure of government, a failure of business. We're starting to see it slow. These indicators are not good. That ISM number has decreased. Now, the next thing I want to talk about is this pending home sales. Now, our prior was 2.8, we were expected 1.5, and we absolutely destroyed it. We got 0.4%. That is awful. So, here we go. the is a leading pending home sales is a leading indicator of housing activity. Measures housing contract activity and based signed real estate contracts for existing single-family homes, condos, co-ops. Because a home goes under a contract a month or two before it's sold, depending how home prices generally leads existing home sales by a month or two. So yeah. Look at that. Okay, again, we are down across the board for pending home sales. You know, the building is weak in the Northeast. It's too expensive. Construction costs are more expensive. So, you know, we see more building in the South, Midwest, or West area, or no, yeah, South and Midwest where it's cheaper. But this West area also is expensive as well. It looks like this Midwest is declining much more rapidly than anywhere else. So it's the South, must be the South and West areas. We went over that information in a previous video. You know, no matter how you spin it, this economic data is not good. It's not good. It's not good. It's not good. It is coming out mixed per se, because let's say, you know, the barometer is anything over 50% is good. So we're at 7.6% higher than below. You're starting to get fucked. You know, if your boss comes by and says, "Listen, you're starting to underperform. What are you gonna do?" You're gonna say, "I'm gonna perform." The boss is gonna say, "You're only 7 orders away from getting fired. If you don't make those 7 orders, you're gonna get fired." How does that sound? That's awful. 7 orders is nothing. We're at 7 points higher than getting fucked. You know, overall, it's not looking good for the economic outlook. You know, even though people are saying, yeah, we're hiring more, this, that, the other thing. You know, all right, let's get into markets. Out of the gate, we had a pretty strong open. Absolutely popped up almost this 400%. I mean, 400 on the CCI. That's beyond insane. Now, what accounted for this was a giant, not a giant, but a big move up in Apple shares, coming from 162 to 167, now slowly backing off. You know, it's like this earnings season's just inflated the markets a little bit. But what we're really seeing, take a look. I'm going to put the /NQ right in the middle here so we could compare the comp and the NASDAQ. Let's check them out on a 1 minute, just so we could see what the deal is. Okay, ready, guys? Check this out. Look at the open. All right. Oh, Jesus Christ. You know, we were declining. All right, first of all, we tried to open up here, but we couldn't. Markets naturally fell. Open. We had this jumble of crap going on. You could see it here. You could see it here. Absolutely up, down, up, down, up, down. You know, if markets are going to actually normalize, this is going to start a downtrend. We have lower lows. We're going to make lower highs, but you never know. We don't know what's going to happen. This is crucial times. I think the only reason that we've been up the last couple of days is because of earnings. Other than that, the market's going down. The economy is starting to slow to the pace where we're in critical, dangerous levels here. But anyway, that's not what I want to talk about. I wanted to talk about this 61%. I said, you know, it's possible that we would have backed off. You know, we'd try and pass it, but we clearly failed it. Now, we failed it once pre-market, but, you know, markets wanted to pop up and fail it. Now, again, we made lower highs looking at a longer-term chart here from Friday's day. You know, we got lower highs. If we beat 719, 7,197, you know, it could possibly mean something. But as far as I'm concerned, this market's overbought. And, you know, if you look at this isn't trading on rational. This isn't trading on rational numbers. These pops have been, earnings, 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 earnings. That's exactly what this has been. This is not logic. This is earnings are past. Earnings of what's been in the past. You have to look. You have to look at forward. What's coming up in the months ahead? What's coming up in the years ahead? What can we see? Let's look at the trend. This is the Chicago index's worst fucking report in a long time. Uh, market marked fall in production drives barometer to 1 year low. We are not doing good, guys. This is going to pick up. Consumer spending increased for the first time, I believe. That's what they're all claiming. We get consumer spending in a little bit. We get it in, let me check here. I guess personal spending. But personal spending, they have to spend more on gas. They have to spend more on literally everything because of inflation. The prices are going higher. People have to pay more for goods that they wouldn't normally have to struggle for. Healthcare's going up. Housing's going up. Gas is going up. Let's keep going. Food's going up. Rent's going up. Uh, Borrowing is going up. Liquidity's drying up. Keep going, guys. Come on. Construction spending's going up. Lumber's going up. Fucking A, guys. Fucking A. Truck cost of cars is going up. Consumers spent more money on cars this year. You know why? Because it's so much money. They're just raising these prices, guys. They're just raising the fucking prices. And now look here. I guarantee you we're going to get truck and auto sales tomorrow. I guarantee you they're going to come out fucking horrible. Horrible. Auto sales horrible. Truck sales are probably going to be good. But, guys, this is fucking horrible. Horrible, horrible, horrible. Sell in May and go away. With everything I just said, I hope you guys have a wonderful day. Keep trading. Take it. Look at what's going on. We failed this 61% here on /NQ. It looks like this little rally is going to be done for. I expect this to continue. I expect this to decline. This is going to go down as fast as we've gone up. Look at this 400 CCI spikes. We're going to experience tremendous pain. Tremendous pain. And I just stopped getting data. Fuck you, Thinkorswim, you piece of shit. Well, I'm not getting data, so I was going to end the video anyway, but that's that. Well, thank you very much, guys. It's been a great episode, and I hope to see you soon. Thank you very much, and take care.